So 2 weeks ago, Bank of Canada have done a 0.5% increase on their prime rate. Though it was more than the 0.25 that they scheduled or anticipated, this is also not a surprise given how high the inflation has been. Now, because of these rate hikes, and there will be more to come, there has been a lot of debate on whether it will really tank the market or house prices will still continue to go up as we have seen previously. So today what I want to do is make a video on this, and what we're going to do is take a look at what is happening in the past first whenever there's a rate hike, and then take a look at the situation on what is going on during those times and how is it different than the ones we're experiencing or about to experience. And then lastly, I'll wrap up on some of my personal thoughts when it comes to housing market and what am I doing with my own real estate portfolio. And if you haven't already, make sure you hit the like button to show support, and you can join our private Facebook group. We have almost 5,000 members in there already. So if you want extra content, make sure you check out the link in the description below. Alright, without further ado, let's jump into today's video. Now let's start off with the past and take a look at different rate hikes period. What has the housing market been doing? And here we are going to majority looking at Toronto, mainly because they have one of the most complete data set and they can give us a glimpse into other cities as well. So I would imagine whatever we're seeing or expecting from Toronto, Vancouver, and even Montreal and Ottawa should expect similar things. Now looking at the last 20 years, there has been two major rate hikes. The first one is from 2004 going to 2007. The other one is 2017 to 2018. So what I did was actually I went into Trap and I pulled every single market watch archive every month, and I hand keyed all the data that I wanted to see onto this huge Excel spreadsheet, and we're going to be taking a look and seeing some patterns from here. So let's first take a look at 2004 to 2007. Now, instead of just looking at rising interest rate that period, we also wanted to take a look at what happens during normal time. So that's why I included a 2000 to 2004 data as well. Now, keep in mind that on the chart, we're going to plot how are the house prices or sales numbers move while interest rate is hiking, but this is not the only variable that is affecting housing market. We are going to take a look at other variables as well to get a more complete picture of what is really going on during that time. So we can see that the red line is the prime rate, and we can see that during that time there has been a rate hike. Now first, if we take a look at the average price over time for all three types of property, house, townhouse, and condo, overall it really doesn't seem like there is any difference. It just seems like market keeps going up in the same pace, pre-hike versus post-hike. But if we actually look at year-on-year changes percentage-wise, then we can see price growth does slow down quite a bit during rate hikes. However, the price did not drop. There hasn't been a negative growth. It's just positive but slower. What was interesting is looking at the sales year-on-year percentage during the rate decrease and hikes. And we can see that every time there's a hike, obviously there will be less buyers for house and also townhouse. However, for condos during major hikes, sales weren't as stagnant as house and townhome. Now this would make sense and can be explained by the fact that house and townhome cost a lot already by then, whereas condos still were affordable after the hikes, so buyers were still okay to keep buying on that side. Now, another interesting thing to see is that back then, people were a lot more sensitive to rate drops as opposed to rate hike. We can see that sales exploded and price changes also were a lot more drastic during rate drops. This does also make sense because it's so easy to access to cheap money, plus there will be a lot of overbidding, so it's going to be attractive for both buyer and seller to be having transactions during those times. It's a lot easier to make decision to sell when you are going to make a higher profit versus when you see a slow market and you're always questioning if you're really selling your property at the highest potential value. Now, one last interesting thing to look at for these 8 years is that if we compare the total growth, looking at the sale price for condo, townhomes, and houses, we can see that condo grew just as much as house overall in the 8 years, while townhome lags behind. And during the period that rate hikes are happening, condo actually on average slightly outgrows houses and outgrows townhome quite a bit. Now we can keep this in mind and see during 2017 and 18 whether the same thing is going to happen. Now for the data, we didn't go beyond 2008 because during that time there's the financial crisis, so rate drops once again and then we enter into a new cycle. So I just cut my data from there. Now, before we take a look at other variables and paint a more complete picture, let's take a look at the pattern that we're seeing from 2017 and 2018 first. So for this period of rate hike, I've included the years from 2014 up to the COVID time as well. I've cut it off at 2020 because once again, we enter into a pandemic. So those data is going to be skewed. Now looking at this time, actually, even though the hike isn't that much, we can see an obvious stagger on house and townhome prices while condos continue to grow. We can actually see a lot more clearly in year-on-year percentage charts. Sales changes also tell a clear story. Both house and townhome sales drop significantly while condos remain even. However, we have to be careful and not to draw a conclusion on this too quickly. This chart does make it look like interest rate has drastic effect on the home price, but we have to keep in mind that during this time, 2017, the government also introduced a 15% foreign home buyer tax in Ontario. Now, if we think from this perspective, then that would make a lot of sense because 20% on a 1 to 2 mil home is very hefty and not a lot of foreign buyers will be willing to pay that. But if they were to just to buy condo with some of their cash, then maybe they would see the 20% tax still could make sense in the long run, and that's why they're still okay to buy condo even during those times. Now, moreover, investors may get pressure at a 1% increase in prime rate on $1 million mortgage versus a $300K mortgage, which is what Toronto condos were going for at that time because they were just costing on average $400K. So it would make sense to see people ditch those two markets and flood into the condo market. Now, as for sales activities, it's very similar to 2007 rate hike. Sales slowed down, inventory builds up quite rapidly during that time. Finally, if we go according to sale prices, during the whole period of 2014 to February 2020, condo actually significantly outgrow both house and townhomes in terms of percentage. And during the rate hike, houses and townhome barely move while condo prices definitely exploded. So this is something I say we can keep in mind as we move forward and look at current situation and assess whether condo is going to repeat the same kind of pattern again. So like I said, those were just the patterns. Next, let's take a look at other variables that are equally important when determining house prices and see what is actually going on during those two periods. And the four variables that I want to take a look at to get a better grasp of the situation is immigration numbers, housing starts, median wage, and the overall sentiment of the market during that time. So first, let's take a look at immigration because this will represent how much hot money or new buyers are coming in that will increase and put pressure on the demand. So I went to StatsCan and I want to know the total amount of people getting PR and also out of those totals, how many were the economic class. And doing so, I also will remove all the refugees, asylums, and also the family class that are coming over. These usually have a lower financial capabilities or desire to get properties, so I want to remove them. Now, I could find the data on total immigration numbers from 2000 and 2010, but unfortunately, I weren't able to find the amount of economic classes that were coming in. So what I did instead is I took a look at the other year's data and I noticed that it's always hovering around the 60% average. So I assume it's also going to be 60%. Now we can see that while we're having more and more immigrants every year, it is actually fairly consistent. So actually, while we have a little bit more immigration at the second rate hike, it's not a whole lot more. However, one last thing to keep in mind, and this is very interesting, is looking at a website for CIC. They said that before pandemic, for these total amount of immigrants coming in or PR being granted, 70% are actually from abroad coming into Canada, and 30% are PR that's already inside Canada, which means most of them are fresh buyers and will have fresh demand on the market. This is very important for us to keep in mind because if we look at the current situation, those numbers are actually reversed. So moving on, let's take a look at housing start. What I did was I went to StatsCan again and I grabbed the total housing start, housing completion, and the housing under construction for every single quarters for different periods of time. Now on the graph, we plotted the three lines for each of those categories and what they were doing from 2000 to 2010, 2014 to 2020, and then further into the pandemic, which we'll cover later on. We can see that new build and completion is pretty consistent for both periods, with new build slightly higher overall when we enter into different cycles, which is why Toronto slowly accumulates more and more under construction inventories. We can see new build keeping steady, but completion dropped during 2014 to 2019, so new inventory actually are coming in at a much slower pace. In combination with slightly higher immigration numbers, this would make sense to see a higher home price growth during this hike because your demand has grown slightly more compared to the last 10 years, but your completion speed actually dropped quite a bit. Now, in our previous video, we've actually also talked about a separate independent report looking at Toronto housing market, and they have actually echoed the same thing, saying that Toronto grossly miscalculated the population growth and the immigration number that will be coming in versus the housing supply they're able to come out with that's completed every year. And because their inability to keep up for the last 10 to 20 years, this led to a crazy increase in rental price and also home prices from the period of 2014 to 2020. All right, so next let's take a look at median wage. This is also interesting because this tells us the people's ability to fund and qualify for their mortgages. Now, without surprise, median wage have not grown much or at all actually. I've actually did a calculation from 2000 to now on the median wage. If we apply the compound interest rate, it came out to be a little bit less than 1%, 0.96%. So every year, people on average are only getting a 0.96% on their salary, which obviously is not going to keep pace with the home prices. By the time we are at the second rate hike compared to previous one, we've only grown 12% in median wage. Now, during those periods, while median wage went up 12% in total, home prices in Toronto went up 50 to 60%, so vastly outpacing wages. However, even at that growth, I would say for both periods of rate hikes, home prices were still considered affordable in the sense that it is still relatively easy to qualify for the mortgage that you need for an average person, which later on we'll take a look at current situation. This is not going to be the case. Now, finally, looking at the sentiment. 2007, maybe Google is not doing a good job to filter very old news, but from what I can gather, there's really not much about the market. Mostly are just commenting that Toronto market is growing at a pretty fast pace, but there is no alarms, there's no worries. Some mention what is considered a real estate crash, but really doesn't have a lot of talks or worry about interest rate or price growing too much. Now, 2017 and 18, then the picture have turned into a lot more worrying sentiments as the foreign home buyer tax helped slow down the market. However, looking at the news clip, mostly it was just people commenting on the slowdown is happening. So in conclusion, if we take a look at the past, we can see the following picture based on what we can find. For the 2006 and 2007 rate hike, it was a steep hike of 2%. Prices continue to grow, but at a slower pace during the hike. Condos and houses are similar in terms of growth, but townhomes lags behind. House and townhome sales do slow down, but condos remain steady. Immigration was steady and slowly increasing, mostly from abroad, 70%. House completion is slow, limiting the supply. Wage not growing, but mortgage very affordable. Not much worrying sentiment from what we can find. And then fast forward to 2017 rate hikes, this is a more mild hike, it's only about 1%. Prices and sales dropped for houses and townhomes during that time, but condos actually kept up and grew even more. But the drops can be attributed to the foreign home buyer tax, we're not sure. Condo massively outgrew the other two types during the hike. Total immigration number increased, but econ class not a lot compared to the last hike cycle. Mostly are coming from abroad again. New start is similar to the last hike, but building speed dropped significantly, which further limits supply. Wage grew a tiny bit only and largely lags behind. Most mortgages, however, are still looking affordable. Sentiment, medium to low worry, I would say. Focus on slow down, not so much about interest rate or FOMO, etc. Now, so those are the two pictures that we saw during the hike. These are things that happened already. Next, let's take a look at the current situation I know we're just at the early stage, we're entering into this cycle, so there's not really much data to look at. But instead, let's take a look at how are we similar or different compared to what we have seen before, and how may these kind of differences affect what we may expect to see in the Toronto housing market. Let's take a look at each variable one by one. Number one, let's take a look at rate hike. We expect it to be 1 to 1.25% this year and maybe another 1% next year. However, we are already at 0.75%, so maybe we are actually going to get a 1.5% plus rate hike by the end of the year. This kind of accelerated schedule obviously is going to greatly affect our qualifying rate. The same person that could qualify for $1 million mortgage probably a year ago is probably only going to qualify for $800K, so their buying power obviously dropped quite a bit. Now, even though our median wage looks slightly higher than 2019, and people did save a lot more during pandemic, don't forget that Toronto properties grew a lot, especially for the 905 area code. We saw a 40 to 60% growth in just these 2 years. These two components mean that people need to qualify for a much bigger mortgage at a much higher rate. This is going to push out a lot of the buyers, especially first-time home buyers that are going for smaller units, or it's going to move a lot of the people that could barely get their townhome or houses. Now they're being forced to push down to the condo level. Now, housing start, which is very interesting, it's dipping in the last couple of months right now, and probably due to high interest rate, high inflation rate, labor cost, it's just not feasible to, or not profitable to start any housing. Completion, however, is around the same, but we can see that there is quite a bit of under construction in Toronto right now, so they would be pending inventory for the next 2 to 3 years. Now you may say, but immigration number is very high though. Take a look at the chart and what they're projecting or hoping to get. Which is true. To make up for the lost number in 2020, government welcomed 4,001 PR in 2021 and expect to welcome even more going into 2024. However, remember what we said earlier. CIC website stated that 70% of the PR now is flipped. They are actually from local, and 30% only is coming from abroad. So if we take the estimated econ class that we're about to see times 30%, we actually are getting less abroad immigrants coming in going forward if this kind of ratio keeps up. Now, what that means is that we probably are not going to get as much new foreign demand, hence a lot less hot money coming in. Finally, let's look at the sentiment. Obviously, overall, people are very worried about the market. Many talks up or even fear mongering at some point about interest rate, inflation, and how you can't afford your mortgage very soon. Plus, stock market right now, as you all know, is doing very poorly overall. Now, some of my clients or subscribers actually messaged me and did point out, hey, will the first time home buyer, this new account that Trudeau have put in the budget, change any demand or supply pressure when it comes to housing market? I took a look at this, and honestly, I read the rules. I don't think it's going to help too much immediately either way, because while it does allow 40K maximum to be taken out tax-free or interest-free to buy a home, you are limited to $8,000 a year restriction. So if you want to fill out the account, it's going to take you a good 3 to 5 years before you can actually max out and use it. So I would say this may be a good news and would put more pressure for the buyers in 3 to 5 years away, but not the immediate one. So right now, I don't see any changes from this. So in conclusion, based on everything we're seeing and compared to what the patterns that we're seeing before and how things may be different, myself had the following expectation for the next 3 to 6 months. House, especially the ones that are over 2 to 3 mil range, so looking at Toronto and Vancouver, will move extremely slow. Sales versus listing is dropping rapidly month to month already, as we can see, and which means inventory is stacking. We should see for these bigger, more expensive houses, a lot more selling under asking. So if you're still thinking about starting low and inducing a bidding war, I would say you need to change your strategy. It's probably not going to work anymore. However, that does not mean that we should expect price to drop back to 2020 level or below. Because of how much we grew, we really need a 30% drop across all housing types, which I think is unrealistic to expect. If it were to happen, it would have to be something catastrophic, like for example, prime rate going to 6%, and then suddenly everyone cannot afford their HELOC payments, and then they have to sell right away. I'm pretty sure that we're going to enter recession well before we hit the 6% mark. Also, mortgage payment do not increase even if you're variable, because we're not adjustable rate mortgage, we're variable rate mortgage. Only interest portion will change. What that means is people getting renewed even now will see a change in their payment, but the rate hike is just starting and not that much. So if they renew now or end of the year, they will lock in their new payment for another 5 years. And so even if the rates keeps hiking after that, it really doesn't affect them too much. Assuming we keep the same rate hike until next year, it's really the people renewing in 3 to 4 years that will see a big change in the payment because they've gotten their mortgage at a bottom rate during 2020 or 2021. Now, townhome probably stay stagnant, but won't drop too much. They have seen to be very slow moving in either direction, both times, and I would expect the same thing now. Condo should see steady increase as people have difficulty qualifying for mortgage, flooding to the condo market since townhome is also pretty limited in supply. However, one thing to note is that in some places like Toronto and Vancouver, one bedroom condo is already at a point that usually first-time home buyer salary cannot qualify for the mortgage unless they go for a 15 or 20-year-old condo, whereas in previous hikes, it was still affordable. This may mean that this time, maybe condo is still going to continue to do well, but we may not see as much growth as we saw in the previous pattern. Now, growth in outer area in the 905 or for example Langley, Delta, or even Surrey for BC, I would expect to see major rebalancing in prices as they grew way too much during the pandemic. Take Toronto townhome for example. In 2022, the 905 area code is almost as much as the Toronto townhome in the main area, whereas in 2020 they were a good 30 to 40% lower than the 406 area code townhomes. Now this brings me to another point that we have to pay attention to. While under construction inventory is building up, we need to be mindful of new start is dropping fast. So we could have a bit of surplus coming in soon, but once rate hike stops, inflation calms down and the buying begins again, the low start that we are seeing today is going to cause a major problem in the future. Now projecting a little bit forward, we already spoke last time that the yield curve inverted in our other videos, and this signals that recession is probably going to come in 12 to 18 months. It has been a pretty good indicator in the past. This actually coincides with what I've seen previously in the last 2 hikes. Every time government hikes the rate 1% or more, we enter into major recession. Yes, the last one was caused by pandemic, but who knows, maybe we would have still got a recession with or without the pandemic. So we could very well see rate goes up right now, everything slows down, even some price adjustment in some area, but then we go into recession very quickly because the economy is very weak, forcing the government to pause the rate hike or even lower the rates once again, and then we're entering into another buying frenzy. So finally, I'm going to share a little bit of my personal thought when it comes to the real estate market and how I'm handling this on my personal side. Though when I research, it does seem like condo market is going to hold steady and even be very resilient during rate hikes, I actually did the opposite. I sold my condo, my investment condo in Surrey, back in January. Now, I did so for several reasons. Number one, it was a good price. I held it for 6 years, and when I was selling it, I got more than double of my purchase price, so the growth has been very, very good. Now, second reason is the concentration in real estate. Because of home prices being so high right now, if I continue to hold more than one property, I really have concentrated too much money in one sector, in one location, and one property type, which I think is not healthy. Now with this sale, I'm now half in real estate and half in other types of assets, and I can continue to get exposure to rental market via REITs and development projects. Third reason is, like I said, I expect a major rebalancing in prices since my square footage in Surrey was fast approaching Burnaby, which to me doesn't make sense. So that's why I think it's at a high point, and that's why I sold at that time. Now, fourth reason is I want to stay more liquid and consolidate my asset. And also in the stock market right now, I know it's very scary to see everything going down pretty much every day, but there is a lot of good buying opportunities right now, and now is the perfect time to really dollar cost average slowly into companies or funds that holds companies that you believe in the long run. I think this is going to net me a lot more return versus holding onto my investment property, hoping it goes up another 5, 10, 20, 25% to give me the same return. And lastly, I do expect a lot of houses, detached homes, to be selling under asking or readjusting their price moving forward. So I want to be ready for it just in case I see something that we want to upgrade to and we can go ahead and buy. Now, finally, I want to talk a little bit about pre-sale. A lot of the people also ask me, should I do pre-sale for investment property or etc. Personally, I have used pre-sale previously due to the fact that I can lock in the price early and are lower sale price wise compared to the outside market because they had to compensate us for the wait time. This is why I preferred pre-sale previously. However, recently for all the projects I looked at, they are either charging as much as the existing condo market out there right now that are ready built, sometimes even more. That and in combination of unknown finishing qualities plus shifting closing date can make financing and arranging current property sales a lot more difficult. It is not as attractive for me anymore. However, it can still be great for people that can't buy right now, you're not ready, but you think you're going to be ready in 3 to 4 years. If you're in that boat, then it's still a great tool for you to use to lock in something today. Now, I did line up my next property that is going to be completing around December as pre-sale, but I only did it because I was able to get close to a 15% discount because I bought it during the pandemic when they were not selling any units at all. I don't think it is repeatable, this kind of discount. And without this discount, back then I would not be locking my money into pre-sale for the previous reasons I listed. And finally, I think that if you own multiple properties right now, especially in Vancouver or Toronto, I suggest you seriously consider and just test the market or talk to your realtor to see what kind of price you may be able to get if you sell right now, and then crunch some numbers, see if it makes sense, and if there's anywhere maybe even real estate or non-real estate investment opportunities that you can see to have a better chance to generate a higher return for you versus holding your property. I'm not saying you should sell right now, but I think you should think about it first. I've had a client that I just met I think 3 weeks ago. They were thinking maybe they will sell, maybe they won't. I talked to them a little bit. I said, based on your retirement situation, I think it's worthwhile to test it out. They said they will only sell if they get a 2.3 mil on the property that they assessed for 2 mil. The realtor put it on an open house, and at the end it was sold within 2 days for 2.5 mil. So they were obviously very happy and surprised that they could get this much on their investment property, and now they can pay off most of the debt, further than reinvest into something like a dividend portfolio that can fund their retirement. So maybe you're in the same boat, maybe this kind of thinking would make sense to you. I don't know, but I think it doesn't hurt for you to test right now while the rate has just started to increase. Slowdown have happened, but it's not at a very, very slow plateau yet. Alright, so that's a longer video, and that's what I wanted to talk about this week, to compare the past, look at the current, and see what we're moving into in the future. If you like everything I'm saying today, hit the like button once. If you don't like them, hit the dislike button twice. Next point I want to hear from you is, what do you think about the housing market in your area? With the rate hike increasing and everything we have just talked about, do you see the same thing as me, or you feel differently? Let me know in the comment down below. And if you like these kind of videos, I do upload them 8:30 EST every Tuesday. So make sure you subscribe to my channel, click the bell button so you get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye!